Welcome to our first in this series of 4 masterclasses. My name is Sarah Hendy and I'm the Strategic Partnerships Manager here at Blackfinch. I'm delighted to be joined today by my colleague Gordon Pugh, who is one of our Executive Business Development Managers. And those of you who are based in the South East will probably all know Gordon. So the aim of these sessions is to actually help either refresh or develop your understanding of tax-efficient portfolios. And today's session is okay. So on to today's session. Obviously, before we start, we have to just cover off the important information. So Blackfinch Investments is authorised and regulated by the Financial Conduct Authority. And whilst all reasonable care has been taken to ensure the contents of this masterclass are true and accurate, no representation or warranty, express or implied, is given as to the accuracy or completeness of the information or opinions contained, and no liability is accepted by Blackfinch. Okay, so moving on to today. Well, as you know, we will be issuing CPD certificates. And for those of you who are able to join each session, we'll issue just one at the end. Obviously, some of you may not be able to join all of the sessions. And if you can't, please do let us know, because we are recording these so we can then afterwards make the links available to you. So just to cover off the learning objectives for today. So by the end of this session, you should be able to highlight the key client suitability concerns when considering EIS or VCT investments, explain the main investment and tax risks associated with EIS and VCTs, and to understand how EIS loss relief is applied. So I'm now going to hand over to Gordon, who will start with the presentation.
Thank you very much, Sarah. And yes, welcome everyone. It's very good to talk to you all. As we said, this is we're taking you on a bit of a journey with this tax efficient workshop, especially through EIS and VCT. Just to give ourselves a little bit of qualification of who's speaking with you. Those that don't know us, Sarah and I have been in this industry for quite some time. I've been in the world of EIS, VCT and IHT through business relief around about 20 years, cutting my teeth at Close Brothers Investment Limited back in the day. And last year, both Sarah and I were invited by the CISI to actually talk on their TV channel for the benefit of their members around estate planning and inheritance tax for those guys. Sarah holds a tax and estate planning accreditation in business relief, EIS and VCT. I have my investment manager's qualification, first level of the Chartered Financial Analysts program. So hopefully you've got in front of you people that do know what they're talking about, a lot of history in it. Luckily enough, again, last year I was asked to give the opening address at the EIS Association. So it's not really there to start boasting and be big-headed about. It's more so that you know that you've got someone in front of you that knows what they're talking about. So let's crack on and let's start in terms of what is an EIS and what is a VCT, and we'll go through the basics of all these things. But I think it's quite interesting actually going back to why did these actual investment regimes come about, and why is the government supporting this? So those of you who are old and grey enough like myself might remember that years and years ago there was a predecessor to EIS called business expansion schemes, and prior to that the UK government actually used to give certain industries grants, and they still do to a certain extent. The agricultural sector gets its own grants and help and so on. But one of the things years ago, and a good example of this, was that the UK government really wanted UK TV and film to be part of the world stage. So back in the day, they might have said, well, let's promote UK film and TV, and let's actually give that industry as a total, maybe a grant of £100 million. And then someone thought about it and thought, well, why are we putting taxpayers' money at risk? Why don't we let private individuals stump up the cash for this, and we'll give the individuals a tax break? So that was really the sort of twinkling in the eye of EIS, back in the day, it was business expansion scheme, as I said. So instead of the government giving a certain industry maybe £100 million, maybe that industry raised £100 million by private investors, and maybe the government only gave away, well, at that time it was 20% income tax relief, so they were giving away £20 million. So it's much more cost effective for the government to do that, and also the underlying companies are actually more accountable because they've got more shareholders that actually ask questions about it. So it's rather interesting to find out where these things come from and how they've actually evolved. And they have evolved in their own lifetimes as well. So you can see here that enterprise investment schemes were actually introduced in the tax year, it was 93, 94. And the purpose was just as I explained then, it was to actually encourage investment into smaller companies. And that has a huge benefit to the UK economy. For all those companies that are, even reasonably successful, those companies are employing people. So people are coming off benefits and employment is getting stronger. Also, if those companies are performing well, then their profits are taxed and we have corporation tax. So the government actually sees more inflows from taxes, from more income tax, more national insurance contributions, corporation tax, etc., etc. Whereas previously it could be the case where, unemployment and benefits might grow as well. So they have a cost reduction and actually a net receipt of income. EIS is hugely popular, and it's actually more popular than VCTs, mainly because of its difference in tax breaks, but also VCTs are there really as an introduction to people into this venture world, and they're there to be made as an easier vehicle for people with more complicated, I wouldn't say sophisticated, but maybe more complicated financial structures in their own wealth. We see that EIS lends itself a little bit more to that side. So we can see here that nearly 30,000 companies have received investment of over £20 billion since the inception of EIS, which is quite remarkable. And then, the last year that we've actually got figures for, being 2017-18, it was around about 4,000 companies received about £2 billion. So it's quite a substantial amount. Now, VCTs came about a year afterwards, and they were there really to simplify EIS. A VCT invests in companies that have exactly the same attributes and parameters as EIS companies, but you're just doing it in one vehicle. So with an EIS, we might invest in 10 companies. We would get 10 different certificates for that, and there'd be a bit more administration. With a VCT, we have a single entity, and that could invest in the same 10 companies, but you just have one certificate and one actual one bit of admin to do. And because of that, they don't give us many tax breaks, and they make it simpler, but then again, it's not so sophisticated in what we can actually do. But however, it is extremely popular, and it does give us a few benefits over EIS, which we'll have a look later on. As you can see, VCTs since inception have raised 8.5 billion, a lot of money, but just less than half of EIS's. And then the last year that we have an estimate for is the last tax year. So that's estimated at the moment. Is a little bit down on the previous year because realistically, the majority of the inflows for VCTs do come in February and March, and that's why we'll have early bird offers to encourage people to come in earlier. And it's slightly dented because of that and the rise of the COVID situation. But still, 620 million is quite significant given this situation. So we've just talked about where these things have come from and how they've grown. We will go through all the tax breaks and the exciting bits, but we can't get away from the fact that we do have risk in these investments. And it's really important that just because of these are tax efficient products, that we don't get swayed by any product provider, such as ourselves or anyone else, in just going down the route of having a look at one particular investment opportunity. Normal fund management strategies do apply. So when I mean normal fund strategies, you're probably all aware of something called modern portfolio theory. Now, that really applies to looking at, it really applies when we're looking at portfolios of maybe equities, etc. So when we're looking at a portfolio of equities, one would say we get full diversification when we have 20 to 40 companies there, with the magic number being around about 30. And the point is if one of those equities was to actually fall in value totally, it should have a negligible effect on the rest of our portfolio. Well, that's not to say that that doesn't equally apply to tax efficient investments. A VCT, you don't have to have 30 VCTs, it's how many underlying companies are there. So we can look at various different offerings out there and say, well, between those different offerings, we should have enough underlying companies. And the same can be done for EISs. VCTs and EISs are classed as higher risk investments, but that risk can also be managed through the actual client's overall asset allocation. So you know what sort of percentage weighting should be in the alternative asset allocation, and you can actually make sure that you don't oversubscribe to EIS and VCT for that particular client. If people are doing an annual subscription, what you want to do is budget for them doing it every year for 4 or 5 years and say, well, let's take that asset allocation for 4 or 5 years and then divide obviously that allocation by the 4 or 5 years so that you can work out what to do on an annual basis. If you're doing it as a single use, then obviously you need to create that diversification in one go, which can be done, but also that could use a bigger proportion of that asset allocation towards alternatives. But then also with risk, the point about tax efficient investments is a great definition I heard years ago, and they're supposed to do the same thing as any other investment, but with the advantage of having a tax break. There's no point having a tax break with the investment not doing as well as something else. And with EIS and VCT, our tax reliefs actually enhance our good outcomes, and they also compensate our bad outcomes. And we have a little bit extra within EIS, which is a loss relief thing, which we'll be talking about later and explain that to you as well. But it means for any company that fails, for a higher rate taxpayer, being a 40% taxpayer, the maximum loss that they can have in any one company should be 42%. So, they should actually have, 58% of their investment back to them, government backed. Nowhere else do you get a government backed effective guarantee, although we can't use the word guarantee, on an alternative investment. If you're an additional rate taxpayer, you get 45% loss relief, which means your maximum loss will be even lower, and it'll be 38.5%. But we'll have a look later on at loss relief and explain that thoroughly for you. So I'm going to hand back over to Sarah now, who's going to give you some idea about some of the considerations that we need to look for clients.
Thanks ever so much, Gordon. Okay, so client suitability, as you all know, is probably one of the most crucial aspects for you to get right. And this is actually even more important now in light of the FCA's recent missive on their alternative supervision strategy. Now, this is a letter that they actually issued in January this year. It's January 2020. And it's actually really helpful because it outlines their view on the key risks of harm that alternatives pose, and also what they consider the supervisory priorities to be. So if you haven't seen this letter yet and you would like a copy, please just either use the chat facility and register your interest, or ping myself, Gordon or Craig a message, and I will make sure that you get a copy of this afterwards. So on to just the main points of suitability. So when you are considering alternative investments for your clients, some of the main points to cover off are, well, obviously, understanding and or experience. So your clients must have the ability to understand the nature of a VCT or EIS, and ideally they should either have experience of investing or will have experience in business or a profession, and therefore be deemed to have the ability to make informed decisions about the investment. Now, your client's capacity for loss should enable the investment to fail and for it not to have a detrimental effect on their everyday financial matters. They should also have a high tolerance and attitude to risk. Now, attitude to risk and capacity for loss are often coupled together. And I often use this example. So if you have a solicitor and a mechanic, they may on a risk profile scale have the same attitude to risk. But due to their financial positions and potential earnings, they could have a completely different capacity for loss. Now, a very important point is to understand the investment timescales and suitable clients should expect their capital to be tied up for 5+ years. Just because the minimum hold period for an EIS is only 3 years, this will not necessarily mirror the targeted exit strategy for the fund manager. And as such, from a liquidity point of view, should your client think that they would need access to the money within the minimum hold period, then this investment is not suitable for them. Now, we all know that the tax benefits alone should never be the main factor for the investment, as these can be withdrawn. However, clients typically would be in a position to take advantage of the tax reliefs, so long as other considerations have been met. Now, it's also really important to bear this in mind when you're considering capacity for loss. And this is something that I always do stress, because should the worst case scenario happen and one of the EIS or VCT companies lose their trading status, and this is something that Gordon is going to cover off later in the presentation, HMRC will look to claw back the income tax relief that has been granted. And you can bet your bottom dollar that when your client got that nice check through the post or the money back into their bank account from the income tax relief, they didn't stick it in their sock drawer. They actually spent it. And that's why capacity for loss is really important. They have to understand, fully understand the implications of the investment. And finally, probably most importantly, a suitable client for either a VCT or EIS should already have a balanced portfolio of conventional investments, so that the risk of investing in either of these products is more than offset elsewhere. Okay, moving on. So the next thing I wanted to cover off was just the main risks, and I've broken these down into 5 categories: liquidity, product, market volatility if listed on AIM, tax risk, and exit risk. Now, picking up on the exit risk, the main difference between the two schemes is that EISs don't offer a buyback scheme, and there's no active secondary market. So for clients looking at EISs, understanding the timescales involved and the fact that their money is tied up for the duration, as I've just mentioned, is really crucial. Clients also need to understand that their capital may not be returned in a lump sum. So if you consider EISs, most clients will have a portfolio of probably 7 to 10 companies. The exits may be reliant on a trade sale or an MBO. So they will all exit at different times. So their capital is going to probably be returned in tranches. Both schemes may be reliant on a smaller number of customers and could have less capital to withstand a decline or downturn in sales. Newer companies may take longer to realize profits or generate income streams. And companies must always adhere to the qualifying conditions, not just at the investment stage, or the tax reliefs could be withdrawn. Now, this is actually a really important point, and it's something that you should always question whichever provider that you're working with about, and ask them how they monitor the ongoing trading activities of the underlying companies. Now, just to let you know what we do here at Blackfinch, is something we do take very seriously, and as such, we work with a company called Philip Hare and Associates, and they're considered to provide the gold standard when it comes to their approach. And obviously, finally here, returns are targeted, not guaranteed. So I'm now going to hand back to Gordon, who is going to look at the different investment stages.
Brilliant. Thank you, Sarah. So yes, a lot of the things we're going to talk about now, we are highlighting risk, but as long as we actually talk to clients about this properly and get the expectations on when these investments may or may not mature, you tend to find that people are quite happy with them. And as long as we give them the expectation that they're medium to long-term investments and they're not a scheme, they're not a plan, they don't have a finite end date, they are typically quite comfortable with them. So although it sounds like a lot of doom and gloom, it's really just to empower you so that you have everything at your fingertips to actually explain these types of investments. And this is where this sort of graph comes in as well. And people say, well, aren't these startups, aren't they really risky businesses and so on? Well, Well, sort of yes and no, and a lot of the terminology gets mixed up. And for most providers, we're not actually investing in pure startups, blue sky thinking, and the rest of it. We've got processes and robustness to go through to actually pick and filter out companies where we think that there's a high probability that they're going to be successful. So when we're looking at a company and starting off its journey, someone comes up with an idea, they incorporate their company, and they actually try and get their product to market. And this investment probably will be coming from their own backing in terms of money. They might have a small business loan. They might have actually attracted some money from some business angels and family or friends and so on. And this is where we see a company really start off at the very beginning of its journey, where we call it the minimal viable product. So they've got a product and they go out to market and they try and sell it, and they've come out with an idea which they think is going to blow everything out of the water, and then they go and find that it doesn't do that, and it's not actually taken up. So they look at it and change it and tweak it, and then they come back to market again and again and again until they get the right thing, if they really believe in it. Now, this sort of stage of company is where you would probably find seed EIS. Now, that's something that's outside the scope of what we do at Blackfinch. We used to do it years and years ago, but that was before the changes through the patient capital review. It's a little bit early stage, and it's quite speculative. You can get a lot of really good tax breaks with it, but then your risk is significantly higher, and they've got a higher propensity for failure. So we look at the next stage, where a company has developed a product and we have what's called product market fit. And you can see here it's on the cusp of their scale up journey. So we're actually starting to hit a curve from just gradual increase to actually really getting some traction. And we want companies that have found this traction and understand why they found it. So it's not just that they've come up with a good product, they've taken it to market, it hasn't worked, they've taken it to market, it hasn't worked, and keep repeating this process until something fits. They wait, they actually know the reasons why that they've actually now gained that success. So we do have some companies which might be pre-profitability as a business, but they will be revenue generating on the whole, all the way up to companies that might have 7-figure annual recurring revenues, and those might be on the actual beginning of what we call the scale up journey, which here is within the growth bracket. Now, funnily enough, because of the differences between the tax breaks you find for an individual between VCT and EIS, at Blackfinch, we think EIS fits in better at the market fit stage, because you get these additional tax breaks that do compensate you if the company doesn't do so well, which gives us an overall better client outcome. Companies that actually are on their scale up journey, which have got quite significant products that have got good traction, those just need some more expansion capital in the main. So an example of one of those with Blackfinch is a company called Cocoon. This is a sleep tech bit of technology. They're halfway, well, they're just over halfway through doing a Kickstarter campaign where they're selling their new product early, ahead of time. So they're selling it for people to get in May next year, but you can buy it now. Obviously, you won't get it till May, but basically you're pre-funding it. They went out for £20,000 of income, and they've actually had £500,000 come in. So companies that have got real followings is what we're after, and that's just an example. We'll actually look at company examples in some of our later sessions, and we'll delve in and really get to the crux. And it's really interesting of how we look for companies and how we help those companies grow, and how those companies find our investment partnership and what they need to do to thrive themselves. So onto the reliefs, and this is where we'll see why EIS possibly suits earlier stage companies. Is what do we have in common between them? Well, both of EIS and VCT have income tax relief, both at 30%. With a VCT, the government minimum holding period is 5 years, and after 5 years you'd expect the product provider, we offer this, to actually do a buyback facility, and that gives you a good exit. Actually, it's a very easy way to get your liquidity. With EIS, the minimum government holding period is 3 years, But with the income tax relief, what we have as an advantage over VCT is that we can actually carry that income tax relief as though the investment was made in the previous tax year. And that's up to you and your clients how you actually allocate that. So there's no particular way in which you have to use up income tax first. You don't have to use up all of this year's income tax before you can carry back. You can elect to carry back all of it to last year, or a proportion, or none of it. So for me, I've just done my tax return. I'm trying to work out, obviously, how much I can actually claim back if I did my EIS investment now against last tax year. Whereas if I did my VCT now, I would really be estimating what my income tax situation might be this year. Now, for people that are very high earners, that's not really a problem. Or if they're not trying to wipe out their income tax situation in one go, that's also not a problem. VCT can work very well there. Now, both EIS and VCT have tax-free capital growth. So any growth we have in those underlying investments will be free of capital gains tax. So that's quite significant. Any upside has got an added benefit to us of not being taxable. With VCT, any growth that we have in the underlying companies, when we sell those companies, that growth isn't paid out as capital gain. That growth is actually paid out as a tax-free dividend. That's something very important for you to know. When you talk with a lot of product providers, they sort of skip over this because they give you the impression, really, that dividends from VCTs are the same as dividends from any other listed companies. And they're not actually. They're actually a payment of growth, capital growth back to yourself, back to the individual. So it is rather different. With any normal stock market company, you would expect certain dividend level, certain yield, and you'd also expect over the long term some capital growth as well. And you don't tend to find that really with VCT. So they're a different type of vehicle. So we get our capital back through the tax-free dividends. The maximum we can do in a VCT is £200,000 per annum. Now, we'll go back to EIS, and you can see that the maximum permitted amount for our income tax relief is significantly larger. We can either do £1 million, or if we use knowledge-intensive companies, which are typically tech companies, we can actually invest £2 million per annum. Now, given that we can carry back, if you have any clients that are in this fortunate position where they've got enough money to do this, they could, in theory, invest £4 million this year. £2 million of that will be classed as though it was invested last year. So it can be used for people with quite significant and complex structures. Now with EIS, through the although we have this extra administration because for each individual company we get their own tax certificate, for that pain going in, we're actually compensated by having some amazing tax breaks over and above what we have with VCT. One of those is we have inheritance tax relief. So this really becomes a great vehicle for if we're selling someone's bond to actually do some IHT planning, we can actually clear the income tax through an EIS as well as getting inheritance tax benefits. We also have capital gains tax deferral through an EIS. So again, if we're moving assets around, if we have a client that has a buy-to-let property portfolio, of course, what we could do is, if they're no longer interested in running that portfolio and managing it, sell their assets, any capital gain, we can defer that through an EIS and again, have IHT benefits. If they can get all the reliefs, capital gains tax deferral, as well as income tax relief, and they're also after doing some inheritance tax planning, I mean, it's just possibly the most advantageous scheme, government scheme out there. And then finally, this is the real icing on the cake for EIS, is we have this thing called loss relief. So for any individual company, and we'll have a look at an example later on, we put our £1,000 in, for example, we get our income tax relief. Say that company goes totally to zero. Effectively, if we take the income tax relief off our initial investment, we're left with a net investment amount of £700. If that all goes to zero, we can claim loss relief against that. So we can actually claim against our income tax liability on that £700 loss, which gives us quite an advantageous position. And it really, really limits our downside, which is quite something. So we've got a few bits here we've touched on. So we've already talked about what the actual income tax relief is. It must be pointed out for both the EIS and VCT, you only get this because we're having newly issued shares from the actual VCT or the underlying EIS companies. We do have our maximums, but one of the important things to note with income tax relief is that it can't reduce an investor's overall income tax liability below zero. So you can't have income tax relief that's negative. So we'll have a look again at that and see a real example in a later slide. Income tax relief is applied in the same year that the shares are issued with the VCT. And if shares are sold within 5 years, HMRC have got the right to claw back income tax relief. And that also goes if you actually dispose with shares at a loss within 5 years as well. But they'll claw back some of it, but not all of it. So you might get a little bit of leeway in terms of what they're actually clawing back. Sarah touched on that they can also claw back if the VCT loses its approval, and this is the same with EIS. It's something to keep in mind, and we actually use a firm called Philip Hare and Associates, which is the gold standard really in this type of tax advice. And we get written tax advice from our tax advisors, which if it turns out not to be the case, we actually could have recourse against that tax advisor's PI themselves. So actually doing these things in a very professional manner, you can see why these things have reasonably large fees compared to mainstream investments. But given the actual work that is undertaken, the fees aren't actually as bad as you might think. And we'll have a look at fees later on. In terms of dividends from VCTs, I alluded to this earlier. They're not to be thought of as the same as dividends elsewhere. They are actually a return of capital. But one of the great things is there's no minimum holding period in order to qualify for tax-free dividends. So, if someone invests with us now, and one of the companies that we have within the VCT has a chance to exit, there is no penalty for that. There's no clawback of income tax relief. We sell that company, the profit is actually paid out as tax-free dividend, and that obviously goes back to the client, and effectively it de-risks the investment at the same time. So that's fantastic. In terms of other interesting parts of it is dividend reinvestment schemes. So this is where a client can elect, not all providers do it, but they can elect really whether they want to buy more shares by reinvesting their dividends. Now, it might be that those shares are issued by the VCT actually buying back shares from the market, in which case they would just continue to get tax-free dividends off those new dividends. But if the actual VCT issues new shares, those new shares can qualify for income tax relief as well. It starts getting a bit complicated, and we have to keep an eye on things and actually have schedules of what's been issued so that you can claim that income tax relief. But it's something that can be extremely advantageous to clients. So this is an example of income tax relief can't be negative, and this goes for EIS equally as for VCTs. So here we have Mr. Thompson, who's lucky enough to invest £150,000 in VCT shares in this October that's just gone. He's entitled, therefore, for 30% of that £150,000 investment against income tax. So he could actually claim £45,000 against his income tax. However, this year he only actually pays £33,000 in income tax. So maybe one could say that he's over-egged his investment in the VCT, but he can claim back all that £33,000. He just can't claim back £45,000, which he could be able to do. So he really, as we say at the bottom of here, should actually have invested £110,000. Or if he'd invested through EIS, maybe he could have claimed some income tax relief against his previous tax year and mopped up the remaining £12,000 that he could possibly have through income tax relief. So that hopefully gives you a few ideas. In terms of EIS, well, it's very similar to VCTs, but just with a few more flexible options around it. So we still have 30% income tax relief in the years that the shares are purchased, or we can carry back some or all or none of that to the previous tax year. The minimum holding period is 3 years, and it could be the case that we actually have a company that sells before those 3 years, maybe within 2 years. Now, if that company sale is sufficiently large, hopefully that's above what's going to be clawed back from the income tax relief, and that would be a great position to be in. But it can happen. Income tax relief has got to be claimed to achieve our tax-free growth. So this is a very strange part of EIS rules. I did say that both EIS and VCTs can have tax-free growth, but with EIS, you only get that tax-free growth if you've either been able to claim all of your 30% income tax relief, or in investing through EIS, it's actually wiped out all of your tax. So that's a strange situation, but again, income tax relief can't be negative. Maximum income tax relief per year is £300,000 or £600,000 if you're using these tech-based or knowledge-intensive companies. We've gone through, what can happen with VCTs, clawback, etc. It applies equally to EISs, so it's just something to actually to be aware of, should it not be monitored properly. But as I said, we use the gold standard at Blackfinch. In terms of further reliefs, we looked at loss relief, and losses can be offset against a capital gain as you would do normally. So you can actually carry these losses forward against future capital gains or income tax. There are one or two other rules, which is where you might have clients who invest privately in companies that are qualifying for EIS. That seems like a good idea, but usually you find that they're quite concentrated and they don't actually have a diversified portfolio. And if they did it with yourselves, they'd have a more professional approach, a more diversified approach. But also there's a few hurdles that they might not have considered when they've made their first investment. And then after they've actually deployed their money privately with another company, it might not be the case that they get their tax reliefs. So they can't have more of a financial interest in the company. They can't be an employee of the company. They can't be associated with the company. So being associated might be through family members, direct family members, etc. There is an exception for business angels who are unpaid directors. And it can be the case that you can invest in them potentially later on, actually be connected with a company. But here we can see as well, we've got some time issues around that.
Okay, so thank you ever so much for that first part, Gordon. I'm going to give Gordon just a second to grab a quick sip of water. So we haven't had any questions through on chat yet, so don't forget you can use that if you would like to. There's just a couple of things that I'm going to pick up on that we've covered off in that first session. So one thing that I just wanted to mention to you, obviously we spoke a little bit and alluded to knowledge intensive companies. I didn't do the whole thing about the definition of knowledge intensive companies. So if anybody is interested and would like to find out more, do let me know, because I can provide a lot of detail around what the definition is and what some of the criteria that the knowledge intensive companies have to go through to be deemed as that. The other thing I just wanted to mention, obviously, is Gordon mentioned about the EIS 3 certificates. Now, again, this is just to manage client expectations. Don't forget that your clients cannot actually claim for the income tax relief until they have received the EIS 3 certificates. And obviously the great thing about EIS is that your clients are diversified, usually over that 7 to 10 companies. But because EISs are a different structure from VCTs, there is one certificate for each company, and they may not all arrive at the same time. So it's really just, again, about managing client expectations, because it could be in some scenarios, and we at Blackfinch work really hard to make sure that this doesn't happen, but some companies may not be able to deploy all of the funds in time to provide the certificate within the same tax year that the investment is made. If that does happen, it means that your client will still have to pay, or they won't be able to claim back all of their income tax relief until that certificate has arrived. So it's not that they can't claim it all back, it's just they can't do so until the certificate has arrived. So again, it's just about managing expectations. Now, the final thing I just wanted to clarify, Gordon obviously mentioned one of the scenarios about HMRC and clawback, and the fact that they will even look to clawback if the shares in an EIS company are sold at a loss. Yes, sadly, that is true. But how it's actually worked out is that the 30% income tax relief that they're looking to claw back will be based on the value of the shares when they're sold. So, for example, if your client has bought shares in a company at £10,000 and they have to sell them at a loss at maybe £3,500, HMRC will then look to claim back 30% of the 3,500. So it would be just over £1,000. So that's how it's worked out. We do have some questions that have come through on chat now. So what I'll do, I'll hand back over to Gordon so he can resume with the presentation. I'll have a look at the questions and then we can cover those off right at the end. So thank you so much for whoever has posed those questions, and we will cover those off at the end. So thank you for that.
Brilliant, thank you, Sarah. So yes, I've had my sip of water. I was just getting a bit parched there. You know, a lot of what we've been talking about so far has been all around about risk and the constraints and so on. But as I said, it's very good to go through these things. The next session we're going to look at not now, the next section next week, we'll be looking at some real powerful planning ideas and a lot more interesting stuff of how we use these types of investments with clients. What we're going to do here is we're going to just go through a few other examples of how people might use some of the investments and just start getting a taste of the sort of clients we might actually might be applicable. So we're going to carry on with actually what the reliefs are, and the next one is reinvestment relief, or what we call capital gains tax deferral. And as you can see here, a capital gain, whole or portion, can be offset by investing into shares in an EIS qualifying company, and the gain is deferred until the investor sells their EIS shares. So it's a few points to bear in mind is we can't have an arbitrage situation. So many of you will be aware that if we're a higher rate taxpayer, if we sell a property that's got an investment property, etc., or buy to let, the actual gain will be charged at 28%. If we invest that gain through an EIS, we defer that tax. Now we're into a company, and then we sell the company shares, the EIS shares, and then the gain recrystallizes and comes out. The gain doesn't actually then become chargeable at 20% because it's come out of an EIS, which was a company and was issued shares. It actually comes out at the rate applied prior to that deferral. So it's just something to be very aware of. The revived gain does actually come out it feels as though it's a new gain when it does come out. So that gives us something that's quite advantageous, because we can use that year's exit capital gains allowance against it. Again, EIS3 certificates must be issued for deferral to be attained. So in this example, you have to have your certificate before you can actually put anything into HMRC, whether it's the EIS form itself or whether it's on your tax return. So with properties these days, of course, we've got 30 days in which we have to pay the capital gains tax. Now, for income tax relief and capital gains tax deferral, with EIS, it was a very good point that Sarah brought up, which is I always tell advisors to give their clients the expectation to actually pay the tax first and then claim it back later, because you'll find that with that one client that's got quite tight time pressures, that will be the client that doesn't get their certificate, or that particular underlying investment doesn't come through. It's Murphy's law, and unfortunately that often seems to be the case. So again, it's just a sensible way to go about looking at getting your reliefs. So let's have a look at deferring CGT using EIS. So here's a straightforward example. We've got Miss Williams, who runs a successful business and recently sold an investment property for £300,000. That creates a capital gain of £75,000. So she discusses using an EIS to defer the gains, and also she can benefit from income tax relief claimed against her income, which could be from salary, it could be dividend, could be rental income from elsewhere, etc. So here we see she has a capital gain of £75,000. Of course, we can use that year's capital gains allowance against it, which reduces the capital gain by £12,300. So the chargeable gain now is 62,700. If we invest that into an EIS, we effectively defer all the tax due on that. So it's most likely that Miss Williams has already paid the 17,556, and then she subsequently invested the right amount of money into an EIS. Then that money comes back to her. Also, because she earns enough, and that could be carried back to the previous tax year and or the current tax year, she's able to claim income tax relief at 30% on the amount she invested in the EIS, being 62,700. So in point of fact, at the end of this exercise, Miss Williams from the gain actually now has an investment that's worth 62,700. She has cash 12,300, which is a CGT allowance, as well as received cash back from HMRC of 17,556, which would wipe out what she's previously paid, but also claim back income tax relief, either against this year's income or previous year's income. So it could be in a much more advantageous position than just actually getting the gain and actually paying the tax due on it. Now, we'll have a look now at loss relief and how this might look. So we put it really in a sphere of what might happen if someone invested through Blackfinch. So with an investment in Blackfinch, what we aim to do is through EIS, we actually aim to create your clients a portfolio of 10 companies within a 12-month period. We're quite good on deploying money. I made my investment last November and I had all 10 companies by the end of the tax year. So that's roughly about 5 months it took for my investments to go through. But here we're going to look at, the whole point of diversification. And, we don't invest your clients' money in 1 or 2 companies. We invested in 10. That's a decent time frame. Within 1 year, we can actually deploy that money into those 10 companies. And here we see that Mr. Richards has invested £100,000 into an EIS. That investment is invested, we'll say, equally into 10 companies. So each company has £10,000 in it. So here you can see that 4 of those companies have totally failed. So that's £40,000 worth of investment is now worth a big fat zero. It's not very good, is it? So let's hope the rest do well. 5 of those companies remaining do well, and they return 1.5 times money. So 5 companies originally would be a £50,000 investment. They've increased by 50%. So they exit at £75,000. We have 1 company that does exceptionally well and returns a 5 times investment. So that £10,000 investment is now worth 50,000. So as you can see, our gross proceeds, what we've exited the EIS is at £125,000. Fantastic. We made a gain from our original investment of 25,000. And let's not forget that's actually free of capital gains tax. So no CGT liability on that growth. We also benefited from income tax relief on making that £100,000 investment, and we've actually benefited to the tune of £30,000. Lovely. We have further benefit because we have loss relief, and we'll look at that in one moment, but that actually accounts for those companies all going to zero. We can get 11,200 back. So you can see our total value to the client, we've called it profit after tax, but the total value after the clients actually exited from all this is that we've got an increase of 25 plus the 30 plus the 11,200, which is an uplift of 66%, all tax free. So how do we calculate the loss relief? So we invested £40,000 in 4 companies. It totally lost all the money. To work out loss relief, it's on what HMRC call the net investment. So that's our investment taking away the income tax that we've already received. So the income tax, 30% of 40,000 is £12,000. You can see there. So effectively, we now are looking at what HMRC class a loss of as £28,000. Being a higher rate taxpayer, I can claim 40% against that £28,000 loss, which is 11,200. If I was a basic rate taxpayer, my rate, obviously the amount would be half that. If I was an additional rate taxpayer, I could actually claim at 45%. So depending on what tax rate you are when we actually create the loss, or a year preceding that loss, is actually how much loss relief we can claim. So here we can see that although we've had a failure, this has given us extra value. And this actually really makes EIS quite attractive for the people that are interested in the underlying investments and probably are going to be higher or additional tax rate payers in the future. So we're not here to give a huge impetus on what we're doing at Blackfinch, but Castle have done substantial due diligence on our products, and we're just going to give you a highlight and taster of the actual proposition. In future sessions, part of it is actually going to look at the underlying with our lead fund manager, and you'll get a taste really of the underlying companies. But in terms of where these companies fit in, we said earlier on, much earlier in this presentation, about how companies are in the company life cycle and how maybe slightly smaller companies fit into EIS and slightly large companies fit into VCT. Well, that still holds true. We've gone through that part of it. Both of them have a focus really on technology, but they are sector ambivalent. We could have things in the leisure sector, we could have wearable technology, we could have medical technology. We don't tend to go down the med tech because it's quite a long route, but finance technology, software as a service, there's all sorts of different sectors that we can actually look at. In terms of how much do we deploy into any one company, well, there's our ranges: £250,000 upwards, maybe up to £1 million for EIS, maybe up to £3 million for VCT. But the typical sweet spot will probably be about £500,000 and above. For EIS companies, we look at companies that have pre-money valuations. That means pre-our investment valuations of between £1 million and £8 million, to give you a rough idea. And you can see there's a slight crossover there, because with our VCTs, we look at companies that have a pre-money valuation of anywhere between £6 and £36 million. The companies have got to be in large markets. We don't want a market where there's high barriers to entry, where they're dominated by one particular player. If we're in that market and someone comes in as dominant, it can be a good thing because they might buy you out. But typically, we want these companies to operate in £1 billion markets, and we just need a thin sliver of that £1 billion to be very successful. The exit, well, we've said 4 to 7 years. It's a little bit more predictable with VCTs. If we have the liquidity after year 5, we will be doing a buyback, and that will give the opportunity for your investors to get out after 5 years nice and neat. And with VCTs, we'll have a look at, in later sessions, really good strategies on how you actually structure the investments with VCTs. And one thing you'll know is it's really good to actually come out after year 5 and reinvest. In terms of the underlying companies, they have to have real exceptional founders, very talented people that are able to actually change what they do and pivot their offering in difficult markets. And you'll find that a lot of the companies that we've invested in have actually done that through the COVID period. With the VCT, we're in an exceptionally strong position because, being a new VCT, it's just full of cash, and all the investments that are being made given the current situation, rather than having some legacy investments which may not be doing as particularly well as they might be. But again, I'm a big advocate of diversification, and I think that we're a good complementer to lots of other providers out there as well. So there is a strong message of diversification. One thing where we do really come across well is, funnily enough, in fees and charges. Our EIS has one of the highest target returns in the market. We're targeting 3 to 5 times returns. Of course, it's within the growth market. Our initial fee is 3%, and that's charged to the investor. Our annual management fee is 2%, but that's actually capped at 4 years. If you do any comparison across anyone else in the market, we're one of the cheapest. Out of those fees, also, there is a benefit through Castle as well, which you can find out through your regional directors as well. So that's can add a little bit of benefit as well. Our performance fees are, again, some of the most attractive out there. So a lot of the competitors will have a performance fee, and that might start once the investor gets back their original capital. Anything above that, they might have a performance fee. we make sure that the client gets at least an uplift of 30%. This is not including the tax reliefs. And then anything in addition to that, we actually then take 20% of that in the excess of that £1.30 for every pound invested. So that's one of the highest hurdles out in the market. Again, we've got the minimum holding period, but the actual realistic target exit will be 4 to 7 years. And that liquidity is actually provided either through initial public offering, it might be through a trade sale, but most likely it's probably going to be a private equity firm coming in and putting in money that will be beyond the scope of EIS and VCT money. In terms of the VCT, we're looking to raise 20 million. We've got just over 4 million in most of that is sat in cash. We're targeting a 5% dividend income, a regular dividend from year 2024. In the meantime, if we are lucky to have some great exits, we'll be paying special dividends, or they might be called extraordinary dividends. So that's for those early exits. Our initial charge is up to 5%. So Blackfinch's charge is 2.5%, and we can facilitate another 2.5% for advisors. Within that, there is an advisor ongoing charge of 0.5%, and that is actually included within our 2.5% annual management fee. So if your client doesn't want to, or if you're not charging your client an ongoing charge, the actual Blackfinch annual advisory fee of 0.5% can be reduced. And again, we've actually got a performance fee that is a high watermark of £1.30. So anything above that £1.30, that's where the performance fee kicks in. So yes, with the rebate of any ongoing charge, you just have to point out what happens there is it's an effective reduction in the Blackfinch fee, but it's not an actual reduction. What we do is we issue bonus shares to the client on an annual basis. So we're coming to the end of it now, all in good time. Just as a recap of the actual tax reliefs, both EIS and VCT benefit from 30% income tax relief. The holding period for EIS minimum holding period is 3 years, but we should expect a longer period of time. For VCTs, it's 5 years. Both benefit from tax-free capital growth. We can defer gains through an EIS. We can also get benefit of business relief and inheritance tax benefits through an EIS where we don't with a VCT. We get loss relief up to the client's marginal rate with EIS, but with VCTs we do benefit from having that return of capital through tax-free dividends. So thank you very much for listening. I think Sarah's going to sum up now and just give you the next stages of what's going to happen with a forthcoming program.
Lovely, thank you very much indeed, Gordon. I hope you all found that of interest. So just really to cover off the learning outcomes, hopefully you should all now know the key client suitability concerns when considering these types of products, understand the main investment and tax risks associated with EIS and VCTs, and be able to articulate how EIS loss relief is applied. As we mentioned earlier, I will be organising for CPD, and we will send around obviously a copy of these slides, and I will also do some notes just to help you as a reminder of what has been covered off today. So we did have a couple of questions that came through. Apologies to Ravi, poor Ravi, he asked a question which I've told him he's going to have to wait for next week to actually get to the answer for, because it was around buy-to-let, and that is one of the client examples that we're going to be covering off next week. So I actually just wanted to put that out to you. If there are any scenarios that you're not quite sure whether an EIS or a VCT would be suitable for a client, please do pop us over an email during the week, and we can look to make sure that we cover that off for you next week. Gordon does love a challenging question, and I like to provide him with a challenge. So that would be absolutely brilliant. One of the other questions that was asked was, obviously, if a client cannot take benefit of the full income tax relief of an investment, is that still okay for the investment to be made? Yes, absolutely. It doesn't matter what amount is invested. You can claim back whatever amount of income tax relief you can. You just cannot be negative. So it actually doesn't matter if your clients cannot benefit from the full income tax relief, they can still make the investment. And actually, if you go back and think about one of the things that Gordon stated right at the front, was that actually these investments should be treated as investments standalone anyway. And then if you think about the tax benefits, they're just a bit of a billy bonus. On that though, one of the things that I just wanted to highlight again was, even though that there is a restriction on the amount of income tax relief that can be claimed on an EIS, there is no limit for CGT deferral. So if you are working with accountants, or if you have clients who are fortunate enough to be in that position where they're either selling a large share portfolio, or they're selling a company that makes rise to a huge capital gain, there is no limit to the amount they can invest to defer a capital gain. And again, this is something that Gordon is going to be covering off in next week's session. So thank you again to everybody for listening. As we all know, I've just seen another question that's come in about CGT upon death. Again, we will cover that off next week, because that is a really crucial part and one of the key benefits of having EIS, how you can actually keep mitigating and deferring CGT, because obviously upon death, it's uplifted. So we will cover that off again next week. Thank you again, everybody, for joining us today. As I say, I hope you all found that of interest. Next week, we're going to be looking at practical and power planning opportunities. So these are going to be case studies that we will look at, which will hopefully give you some new insights into how both EIS and VCTs can be used. As I said, any questions that you think of during the week, do let us know and we will cover them off. Thank you very much for joining. See you all next week.